Welcome to the deep dive. Today, we've got the 2022 shareholders letter from Fairfax Financial Holdings. And we're really going to try and get under the hood of this sprawling company known for a very unique insurance and investment approach.
Yeah, it's quite a document you shared. It really paints a picture of, well, standout success in a year that was, frankly, brutal for most players out there. 2022, you had market chaos, soaring inflation, rates going through the roof.
Which usually crushes portfolios, right?
Exactly. Especially fixed income.
And that's the paradox, isn't it? That's what we need to unpack for you. You look around, most competitors, their book value per share, kind of that core measure of what a company's worth, it dropped, what, 10%, maybe 30%?
Yes, significant drops across the board.
Fairfax, their book value went up 6%, and the stock price jumped nearly 30%. So our mission today is figuring out the strategy, the thinking behind that. It feels like a real lesson in being prepared.
Well, the core of that initial success, it really seems tied to one big decision they made over the years before. Simply refusing to chase yield when interest rates were basically zero.
Right. Everyone else was stretching further out, buying longer-term bonds to get any return.
And those longer bonds got hammered when rates rose. Fairfax, though, they prioritized liquidity. They wanted flexibility.
Liquidity doesn't always feel great in a bull market, does it? You feel like you're missing out.
It can feel like a drag, yeah. But it became their absolute lifeline here. End of 2021, get this, 50%, half of their entire investment portfolio was just sitting in cash and short-term T-bills.
So when the central banks hit the brakes hard.
Fairfax was sitting pretty, perfectly positioned. That short duration setup meant as their bonds matured, which they did quickly, or as cash came in, they could immediately reinvest it and capture those much higher yields.
And that must have dramatically changed their income picture.
Oh, massively. Instantly. The annual run rate, the projected income from interest and dividends, it soared. Went from about $530 million at the end of 21 to around $1.5 billion.
Wow. Almost $1 billion jump just from having cash ready.
Pretty much. Just from that tactical positioning, that liquidity advantage, it really shows sometimes, like you said, being prepared, having that cash ready for the storm is the best offense.
But it's not just a one-off for 2022, is it? This discipline seems baked in. Looking back since 37 years.
Yeah, long track record.
Their book value per share, and this includes the dividends they paid out, it's compounded at 18.5% a year. The stock price, not far behind, 17.3% a year. That's serious long-term performance.
It really is. And what's, I think, really fascinating now and important for you listening to grasp is how management is shifting the focus. They're saying, okay, forget the volatile market swings for a minute. Let's talk operating income.
Okay.
They're now projecting annual operating income of over $3 billion.
$3 billion. And they break down how they get there.
Yep, they lay it right out. About $1.5 billion from that higher interest and dividend income we just talked about. Then over $1 billion from underwriting profit in the insurance businesses.
Okay, solid base.
And then another $500 million plus from their non-insurance companies. Add it all up, and they calculate it translates to roughly $100 per share in earnings. And that's before any potential gains from the stock market.
Why is that $100 number so significant? What does that signal?
Well, think about it. For a big, complex conglomerate like Fairfax, which often trades at a discount because people see it as complicated or maybe volatile, generating $100 a share in just steady, predictable operational earnings, that proves the underlying engine is huge and reliable.
Right, it's not just market bets paying off.
Exactly. It changes the story. It's not just savvy investor, it's consistent earnings machine. It kind of puts a floor into the business value based purely on running their operations well. Makes them less vulnerable to just short-term market jitters.
And that stable platform, that reliable earnings engine, it really rests on their core insurance operations, doesn't it? They've grown incredibly fast there.
Oh, yeah. They're now one of the biggest property and casualty insurers globally. The key thing, though, is they always say they prioritize making money on the underwriting itself, not just growing for growth's sake.
They don't just chase market share.
Right. And the numbers back that up. Gross premiums written, basically the total amount of insurance they sold, it doubled in just 5 years. From about $13.8 billion in 2017 to $27.6 billion in 2022.
Wow. And that was during a hard market, right? When prices were going up anyway.
Exactly. Our market started around 2019. That's when insurance prices rise because maybe claims have been high or some insurers pull back.
So how does their structure, this decentralized model they talk about, help them win in that kind of environment? Why does not having layers of bureaucracy matter?
Well, in a hard market, you need to be nimble. Pricing decisions, deciding what risk to take on at what price, it needs to happen fast, close to the customer. Big, centralized companies can get bogged down. Approvals take time.
Okay.
Fairfax gives its local company presidents, many who've been there for ages, the power to adjust pricing quickly, grab opportunities while the market is favorable, often before the slower giants can react.
So discipline becomes offense.
That's a good way to put it, yeah. And you see it in the results of the individual companies. Like Odyssey Group grew 141% to $6.6 billion in premiums. Crum & Forster up 116% to $4.6 billion. Decentralization fuels that responsiveness.
And the result was profit. Record profit, actually. $1.1 billion in underwriting profit for 2022. But hang on. Didn't they also have massive catastrophe losses that year? Like Hurricane Ian?
They did. Record cat losses, $1.3 billion absorbed in 2022.
So how do you make a record profit while paying out record disaster claims? That sounds almost impossible. Was it just luck or reinsurance kicking in?
Less luck, mostly discipline. Their overall combined ratio was 95%. That means for every dollar of premium they took in, they paid out 95 cents in claims and expenses, so they made 5 cents before any investment income.
Even with the $1.3 billion hit?
Even with that hit, it shows their underlying pricing was strong enough. Look at their best performers. Northbridge hit an 89% combined ratio, Allied World 91%. These guys generated record profits for Fairfax. And Odyssey Group, that company, has now been profitable on its underwriting for 11 straight years.
11 years. Okay, that's consistency.
They're absolutely focused on writing profitable business, not just volume.
Which brings us to the magic ingredient for insurers like this. Float. Can you just remind us what float is?
Sure. Float is basically the money, the premiums, that insurers collect up front from policyholders, but they don't have to pay it out in claims until potentially much later, sometimes years later.
So they get to hold on to it and invest it in the meantime.
Exactly. It's capital they get to use essentially for free, or even better than free if they underwrite well. And Fairfax's float has grown massively too, up 36% since 2017, hitting $31.2 billion in 2022.
$31 billion they get to invest. But what about the cost of that float? Don't insurers usually lose a little on the underwriting, meaning the float isn't quite free?
Often, yes. Many insurers have a positive cost of float. Maybe they lose 1 or 2 cents on the premium dollar, so they're essentially paying a small interest rate for that investable money. But Fairfax, because they're so focused on underwriting profit, flips that script.
Okay.
In 2022, their underwriting was so strong, the cost of their float was actually negative. It was a 4% benefit.
A benefit. Hang on. So just so you listen and get this straight. A benefit means they were actually making money from the insurance operation itself.
Correct. 4 cents on the dollar profit from underwriting.
And they got to invest the $31 billion float that generated that profit.
You got it. They're effectively being paid to hold and invest customer money. That's the holy grail in insurance. Generate underwriting profits and get free, massive leverage through float. That combination, that huge float earned at less than zero cost, is why they argue their real intrinsic value is way higher than what the balance sheet, the book value, might show. Okay, so shifting gears a bit from operations to how they deploy capital, 2022 wasn't just about managing the core. They made some big strategic moves too, really showed off their trading and allocation skills.
The headline grabber was probably the pet insurance sale, right?
Absolutely. They sold their pet insurance business companies like Crum & Forster Pet, Pet Health to JB Holdings. Big price tag, $1.4 billion. And that resulted in a pre-tax profit for Fairfax of $1.2 billion. Just a massive gain.
But wait, if their whole philosophy is long-term compounding, owning great businesses forever, why sell a high-growth, profitable business like pet insurance? Isn't that kind of contradictory?
That's a great question. It really highlights that they see themselves not just as passive long-term holders, but as active, opportunistic capital allocators.
Okay.
They likely saw peak valuation in the pet space, lots of consolidation happening, and decided it was the right time to crystallize a huge gain. It shows they can be nimble traders when the price is right. And crucially, what did they do with that cash?
Ah, right. Where did the $1.2 billion go?
Well, a chunk of it went right back into those high-yield short-duration notes we talked about earlier, perfectly timed for the rising rate environment. So sell high, redeploy smartly. That's capital efficiency.
Makes sense. We also saw them continue taking companies private. Recipe Unlimited, the restaurant group.
Yeah, they took Recipe private, paying a pretty hefty 53% premium over the pre-announcement price. The reasoning given was to, quote, rationalize its operations in a private format. get it away from quarterly market pressures. Fairfax now owns about 84%.
And they did something similar with Atlas Corp, the shipping and energy company, but slightly different structure.
Right. With Atlas, Fairfax already owned 45%. They partnered with David Sokol, a respected operator, in a take-private deal. But Fairfax rolled its entire stake forward. They didn't cash out. They stayed invested alongside management they clearly trust. It's another vote of confidence in letting strong leaders run businesses without public market distractions.
So, lots of wins. But the letter also included a counterpoint, didn't it? Something showing not everything turns to gold instantly. The Resolute Force Products example.
Yeah, that was an important bit of balance, I thought. They mentioned the planned sale of Resolute. Now, this was an investment they made way back in 2008, held it for nearly 14 years. Their net investment was around $715 million.
And the return.
Looks like they'll basically just break even after all that time.
13 years for break even?
Yeah, and that's instructive, right? It shows that long-term discipline isn't just about hitting home runs. It's also about patience, not throwing good money after bad if something isn't working out as planned, and having the discipline to exit, even if it's just for your money back. That's risk management, too.
Good point. And finally, on the people side, aligning with that decentralized trust in leaders, there were some key promotions mentioned.
Yes, Matthew Wilson stepped down as CEO of Brit for health reasons, and Martin Thompson took over internally. And significantly, Brian Young, remember, the CEO of Odyssey Group, the one with that amazing 11-year profit streak.
It's our star performer.
He was given additional global oversight for all of Fairfax's insurance and reinsurance companies while still running Odyssey Group. That's a pretty clear signal. Proven operational success gets rewarded with broader strategic responsibility. Promoting from within, trusting your winners. So you take that operational success, that underwriting discipline, you combine it with the liquidity they carefully preserved. What does that allow you to do?
Make big bets when you see an opportunity.
Exactly. It enables high-conviction, long-term investments. And if their philosophy is about finding great businesses, maybe in places the market undervalues, there's one country where they are clearly placing a massive long-term wager.
India. You can really feel the enthusiasm in the letter when they talk about India. They flat out call it the single best country in the world to invest in for the long term. That's a strong statement.
Very strong. And they back it up with specific reasons. They point to what they describe as transformational changes happening on the ground. Now, we should be clear. We're reporting what the letter states regarding achievements attributed to Prime Minister Modi, not endorsing any political view ourselves.
Right, just conveying the investment thesis.
Yes. The letter cites things like rolling out medical insurance aimed at the poorest 500 million people, the installation of 120 million toilets for basic sanitation, and enabling direct government payments by getting 400 billion bank accounts opened, mainly for rural citizens.
Those sound like foundational shifts, building blocks for a modern economy.
That's the argument, that these kinds of changes create a massive, growing domestic market and improve the quality of life and economic potential for hundreds of millions. It's about creating a stable foundation for growth.
And they have investments there that seem to be proving the thesis.
Apparently so. Digit, their insurance tech investment in India, it's gone from zero to over $900 million in premiums in just 5 years. The compound annual return on that investment since 2017, a staggering 79.5% a year.
Okay.
And Bangalore International Airport, which Fairfax India calls its crown jewel, they successfully built and opened a huge new terminal, Terminal 2, in just 4 years. And remember, 2 of those years were heavily impacted by COVID. So execution seems strong on these big projects.
Shifting focus a bit, what about their broader view on investing, the overall market?
Well, they definitely doubled down on the idea that what they call the renaissance of value investing, favoring real assets, real earnings over just hype, really started in 2021 and carried right through 2022. They were pretty blunt about the speculative froth that came before the rate hikes.
They gave some pretty stark examples of that bubble bursting, didn't they?
Oh, yeah. By March 2023, they pointed out Zoom was down 84% from its peak. Lemonade, the insurtech, down 92%. Bitcoin down 68%. They explicitly compared it to the dot-com crash, warning that many companies burning cash without real profits might just disappear.
So, looking ahead, what's their big macro concern?
Credit. It comes down to credit. They believe higher interest rates aren't just repricing stocks, they're going to start exposing weaknesses in the credit system. The argument is that a decade of super easy money has maybe papered over some cracks, allowed fragile financial structures, they even use the term Ponzi finance, potentially to build up, especially in the US and Europe. higher rates will test that foundation.
Okay, a cautionary note there. And one last point from the letter, reflecting their culture, they spent quite a bit of time talking about Ukraine.
They did. It was quite detailed, actually. They talked about their efforts to support their employees. They have over 1,500 staff and families in Ukraine, using their global network for financial help, logistics, relocation support after the invasion. It underscored that their decentralized model isn't just about structure, it's built on valuing the people within it.
So, wrapping this all up, what's the big takeaway for you listening to this?
I think the whole 2022 story for Fairfax boils down to preparation meeting opportunity. It sounds simple, but it's hard to do. They had the discipline for years to not stretch for that extra bit of yield when rates were low.
They accepted lower returns then.
Exactly, which meant when the market turned, when rates shot up, they had the firepower, that massive liquidity, to both weather the storm and capitalize on it, generating huge income gains and dramatically outperforming. It comes back to those core ideas. Underwrite, for profit, always. And keep your assets flexible, short duration, ready for anything.
And that long-term track record we mentioned, 17.3% annual stock return over 37 years versus maybe 10.6% for the S&P 500. The letter puts that into perspective. It notes that if you looked at all the, 6,000 companies listed on major U.S. exchanges back in 1985,
Yeah.
only about 1% of them managed to compound their returns above 15% a year over that entire 37-year period, just 1%.
Wow. That really tells you something, doesn't it? True, consistent, long-term wealth creation isn't about being brilliant for a year or two. It's about that relentless, maybe even boring sometimes, discipline, year in, year out.
The ability to be different, maybe look wrong in the short term, like holding 50% cash.
Right. That capacity to stick to your principles, even when it's uncomfortable, that seems to be the real power behind their long-term focus. And they'd argue, as they do in the letter, that their intrinsic value driven by that massive cost-free float engine is still significantly higher than what the market might recognize just looking at book value.
A fascinating case study in patience and preparedness paying off. Thanks for diving in with us on this deep dive. We'll catch you next time.